All right, welcome to the Explainer. Today we're digging into a really interesting one, Ravelin Properties REIT, and the ticker for that is RPR-UN.TO. So let's just get right into it. A stock trading for just 2.5 cents? I mean, that looks super tempting, right? But is it a massive opportunity, a hidden gem, or is it just a classic value trap, a financial landmine waiting to go off? That's what we're here to figure out. Okay, so to really kick off this investigation, we've got to look past that tiny price tag. We need to build a profile of the company itself. What kind of business are we actually looking at here? Okay, so here's the deal. Ravelin is a real estate trust, and it has some pretty substantial properties that are actually generating cash. But, and this is a huge but, the company is crippled by some really severe financial distress. We're talking massive debt and negative equity. So the key thing to get here is that the business itself, the buildings, the rent collection, that part works. The problem is the company's financial structure is just, well, it's completely broken. The assets are doing their job, but the company itself is failing. And what that means is the market isn't even looking at this like a normal investment. Not at all. It's being treated as a restructuring situation. And in those situations, it's the creditors, the people the company owes money to, who hold all the power, not the shareholders. So yeah, the normal rules of investing, they just don't apply here. This is a totally different ballgame. We're not trying to figure out if a healthy company can grow. We're basically analyzing a patient in the ICU to see if it's even going to survive. All right, let's start digging into the financials, because this is where we find the first and maybe the biggest misleading clue. This is the number that looks so good it could easily suck an unsuspecting investor right into a trap. Take a look at this. The price to funds from operations, or FFO ratio, is just 0.08x. Now, FFO is a really key cash flow metric for real estate investment trusts, for REITs. And a ratio this low, it looks absurdly, ridiculously cheap. It screams massive bargain. It's the kind of number that makes your eyes pop and you think, wow, I've just stumbled upon a once-in-a-lifetime deal. But that's when the alarm bells should start ringing, right? What's the catch? Why on earth would a company that's generating cash be valued so incredibly low? This is the question every single financial detective has to ask. Because when something looks this good, too good to be true, it almost always is. And the answer, as it so often does, is hiding in plain sight on the balance sheet. And wow, this slide just lays it all out there. This is the real story. The market cap, that's what the shareholders own, is about $2 million. But the total debt, what the company owes, is $1.13 billion. The debt is more than 560 times the value of the equity. Just let that sink in. For every single dollar that shareholders have in this company, the creditors have a claim to over $560. It means the shareholders' claim on the company's assets is, well, it's tiny. It's almost non-existent. And this quote from the analysis just hits the nail on the head. It says, the balance sheet is not weak. It is structurally broken. Think about that phrasing. This isn't just a little problem, like a crack in the foundation. This is saying the entire foundation has completely crumbled. And the evidence just keeps piling up. Look at these red flags. The book value per unit is negative 36 cents. That means the company's liabilities are worth more than its assets. It's technically insolvent. The current ratio is 0.03. That's basically zero. It means they have almost no ability to pay their short-term bills. And of course, the dividend has been suspended. They've stopped paying investors. So yeah, the financial picture it's pretty grim. Let's put this all together now and weigh the evidence. Let's look at the strengths, the weaknesses, and what the potential outcomes or scenarios could be. Is there any hope at all here? And this weighted SWOT analysis really confirms everything we've been seeing. The two most important factors, the balance sheet weakness and the liquidity risk, they're given the highest weights in the analysis, and they get a score of 1 out of 10. 1. So those fatal weaknesses just completely overwhelm any potential strengths, like the fact that the assets generate cash. And it all adds up to a really bleak total score of just 3 out of 10. So what does this all mean for someone thinking of investing? Well, this analysis lays out a few possible futures. The bear case, which is listed as the most probable, is that the equity gets completely wiped out in a restructuring. Translation, shareholders lose everything. The base case, well, maybe the company survives, but only with heavy dilution for the current shareholders. That means they'd have to issue so much new stock to stay afloat that your existing shares would become almost worthless. And the bull case, the perfect turnaround? Yeah, that's rated as unlikely. Okay, but let's say you're a gambler. You see this and you still want to make a speculative bet. let's look at the numbers and see just how bad the odds are. Let's really quantify the risk and reward profile here. So this analysis is looking for a pretty modest return, right? Just 9% a year. But to even have a chance at hitting that, you need to buy the stock for a lot less than what it's trading for right now. If you're looking at a 5-year hold, you'd have to get in at under 2 cents. And if you're planning to hold for 16 years, you'd need to buy it for a penny. This just shows you how stacked the odds are against you at the current price. And if you needed any more confirmation, the formal financial risk score comes in at a whopping 8.9 out of 10. That is extremely high. The analysis is basically screaming that there's a high probability of permanent capital loss. And on the flip side, what about the opportunity? Well, the opportunity score is a really low 3.8 out of 10. And that just confirms the whole story, doesn't it? The potential upside is absolutely dwarfed by the immense risk of losing all your money forever. So, okay, we've looked at all the evidence. We've seen the broken balance sheet, we've uncovered that misleading valuation metric, and we've quantified the terrible risk profile. I think it's time to close the case and deliver the final verdict. So let's just recap the key takeaways here. First, this is not value investing, not even close. This is pure high-risk speculation. Second, the operating business, it's basically owned by the creditors, not the shareholders. That low stock price, it's not a mispricing, it's a reflection of the insolvency risk. And with a negative book value, there's absolutely no margin of safety. There's nothing to catch you if things go wrong. The most probable outcome here is a total loss for anyone holding the stock. And so, our final verdict, based on the source analysis, for a long-term investor who's looking for at least a 9% return, it's an unambiguous sell or avoid. The risk of permanent capital loss is it's way too high. And that wraps up our investigation. This was a textbook case of a value trap, not a value opportunity. Now, we'd love to know what financial mystery you want us to dig into next. Let us know which stock you want us to analyze. Just drop your suggestions in the comments below.